This is a video on the allowance for bad debt and bad debt expense. We're primarily going to be focusing on the two approaches, the income statement approach and the balance sheet approach. So the case is hard pressed, and it is attached to this video. You can also find it online on Blackboard under the Activities tab. So you should take a minute, you should print that out and read it before we get started. Okay, so we're going to start with the income statement approach, and we're going to just basically jump right into the journal entries for period one. So the first thing we know is they had sales, and all sales are on account. So they have accounts receivable and sales. And the sales were $5,750, and $5,750 was the sales. Okay, and it all goes into receivables. We're going to ignore cost of goods sold for this problem because we want to primarily focus on the allowance piece. And that's why you see in the activity a line item for gross profit assume, because we're going to just use that as our gross profit number when we calculate the income statement. All right, they also had some cash that was received. So we had cash of $5,400, and that would be our accounts receivable, $5,400. Okay, so the only other, I'm going to go ahead and post these then. So we had our beginning balance in accounts receivable, I believe, was $1,200. And so we post the $5,750 to that account. We're going to post $5,750 to our sales. We're going to ignore the cash account, and then we're going to put that so much was paid from the accounts receivable. And that was $5,400. So our balance in the accounts receivable account at this point in time is $1,550. Okay. Now, under the income statement approach, the approach does this: it takes the sales number. So let me do it over here. It takes a sales number, and in this case, it's $5,750, and the methodology applies a certain percent of all sales are expected not to be collected or not to be paid. And in this case, it's 2/5 of 1%. Okay, so 2/5 is 0.4, and 1% is 0.01. So 2/5 of 1% is actually 0.004. So the rate is 0.004. So the amount that we're going to calculate here then is $23. So the journal entry then we will make for this account will be bad debt expense, and the allowance for bad debt. And it will be $23. So this is actually the expense that will show up in the income statement for this period or for the first quarter. And the allowance for bad debt is a contra account. Is a contra account to the accounts receivable. So if we were to show accounts receivable net, it would be the accounts receivable minus it. So let's go ahead and do that. Let's just do that real quickly here. So if I was to show, let's just start out, I have sales and I have my cost of goods sold, and let's just start with gross profit. And if my gross profit is $2,300 in that first quarter, I'm going to have a bad debt expense, which I'm going to label BDE here, and $23 is my bad debt expense. So my net income, holding everything else constant, would be $2,277. Now, the balance sheet approach, the balance sheet presentation of this would be our accounts receivable, the $1,550, less the allowance for bad debt of $23. And so I would show on my balance sheet accounts receivable net of $1,527. And that's what would show up on my balance sheet. And we're just going to ignore this stuff. All right, so let's go back and do some journal entries again for year 2, which gets a little more complicated. So in year 2, we have sales of, I believe, 6,500. Okay, and they are all on account. We received 6,200 in payment on our accounts receivable. Now we have a couple other things that happen. We actually have a write-off. We actually deem of some of these accounts receivable aren't going to be collected. And when that happens, we debit the allowance for bad debt. And we're going to debit it, and then the amount was $10. And we credit the accounts receivable for $10. So the net effect, if you think about this, if accounts receivable is going down by 10, right? So we're crediting accounts receivable by 10, and we're debiting allowance for bad debt by 10, the net effect on the balance sheet is 0. And that's the whole point of setting up the allowance account. When the event actually happens, the balance sheet impact is 0. And you can see there's no income statement effect here either. These are just balance sheet transactions. We have two other transactions that are going to happen. We actually we collected some money we had previously written off. And when that happens, it's a two-step process. First of all, you reinstate the accounts receivable for the amount you wrote off. And so you debit the accounts receivable and you credit the allowance for bad debt. So basically, you're reversing the entry right above. And then you're going to show the cash coming in of $4 and as a debit and credit your accounts receivable for the $4. So basically, it puts the money back into the bad debt expense. So let's post these. I mean, maybe I'll make it a lot more clear. So we're going to post this amount, $6,500, to our accounts receivable. $6,500 to sales. We're going to ignore the cash, the $6,200 payment on accounts receivable. Okay, $10 debit to the allowance for bad debt. $10 credit to accounts receivable. We're going to debit accounts receivable for $4. We're going to credit the allowance for bad debt for $4. So we've picked up these two 4s. And then we're going to credit cash and debit accounts receivable. So in some respects, you can see these two 4s will cancel each other out. Okay, so our balance in accounts receivable after all this is $1,840. Our balance in the allowance for bad debt account, well, we're not quite done, so I'm not going to do that yet. Remember, under the income statement approach, I'm going to take my sales number, 6,500 in this case, multiply it by the 0.004. And so my balance is $26. So the bad debt expense is $26, and the allowance for bad debt is $26. So I'm going to post that bad debt expense there for $26 and put this in the allowance account. And so my balance in the allowance for bad debt account, after all is said and done, is $43. Okay? Should we do the balance sheet and income statement real quick? Let's do. So again, we're going to ignore the sales and cost of goods sold. Just assume that the gross profit is $2,600. So in this case now, we're going to record into the bad debt expense $26 because that's how much we accrued in the period. And so our net income will be $2,574. Okay, the accounts receivable balance, we had $1,840. And now in this case, while this is the 26, the allowance for bad debt is cumulative. It's a balance sheet account. So it will be a negative $43. And so we have a balance of $1,797. And this is the accounts receivable net that would show up on the balance sheet. Okay? We're going to go ahead and finish this up and do the very last year also, just so we are consistent. So the sales in third year were $7,000. So that will be a debit to accounts receivable and a credit to sales. We actually received $6,400 on those accounts receivable for the period. The company wrote off $30, so they're going to debit the allowance for bad debt for $30 and credit accounts receivable for $30. We actually recollected $2 we had originally written off, so we're going to debit accounts receivable, credit the allowance for bad debt, and then debit cash and credit the accounts receivable account. And then we'll do that very last posting, so 7,000 times 0.0004, and that number is 28. So we will debit the bad debt expense of $28 and the allowance for bad debt of $28. So you can see that our expense that we record every period is based on the sales we have in the period. It's not based, there's no correlation in any one period with the amount we write off or deem uncollectible with the amount we're actually expensing. And what this does, the allowance for bad debt account, it creates a rational and systematic way to allocate the expenses between periods. All right, so let's post these items. Post 7,000 to the accounts receivable account. Post 7,000 to the sales. We're going to post $6,400 to the accounts receivable account. We'll ignore the cash. We'll debit the allowance bad debt account for $30. We'll credit accounts receivable for $30. The amounts we recollected, I'm going to debit accounts receivable for $2. I'm going to debit the allowance for bad debt for $2. Cash we're ignoring. The accounts receivable account is $2. So I've picked up this number, and then I'm right here. So my bad debt expense, I'm going to debit the allowance, the bad debt expense I'm going to debit for $28. Pick that up, and then I'm going to credit the allowance for bad debt for $28. So the balances now I have in my accounts receivable account at this point is $24.10. And the balance I have in the allowance for bad debt is $43. Okay, if we were to finish this up and do the balance sheet and income statement, we'll see a gross profit. Again, this is just given. We'll put a line there, the $2,800. And again, the expense in this period was $28. And so my net income, holding everything else constant, will be $2,772. My accounts receivable I've shown on my books was the $24.10. The balance in the allowance for doubtful accounts at the end of the period was $43. Is that right? Let me check that. That's what it is last period. It's 43. Lo and behold, $43. And so my ending balance is $2,367. Okay, so this is the allowance for bad debt expense and the bad debt expense using the income statement approach. In the next video, we'll do the same activity, but we will be focusing on the balance sheet approach.